This is question number 1 on homework 4 for session 4 on capital budgeting. So this question is kind of a capital budgeting problem related to the consistency between the discount rate and the cash flows. So the rule is that if we want to use nominal cash flows, then the discount rate also needs to be in nominal terms. And if we want to use the real cash flows, then the discount rate also needs to be in real format. So we should keep that rule in mind in working on this problem. So let me just briefly read the setup. I've been considering the purchase of a new manufacturing facility for this. So we know that this is kind of a capital expenditure, right? The facility is to be fully depreciated on a straight line basis over 7 years. So that means every year's depreciation expense can be calculated by dividing this initial cost by 7. Right? It is expected to have no resale value after the 7 years. So what this means is that we don't have to consider the terminal value, right? Because a salvage value for this facility, because there's no resale value, and after 7 years, the book value of this facility is also 0 because it's fully depreciated over 7 years. So operating revenues from the facility are expected to be this amount, and just notice here it says in nominal terms. And the end of the first year, and the revenues are expected to increase at the inflation rate of 5%. So this sentence has two connotations actually. One is that it tells us what is the inflation rate. And second, it also tells us the growth rate of the revenues. So both information will be quite useful later. Production cost at the end of the first year will be this amount in nominal terms. Again, this is in nominal terms, and they are expected to increase at 6% per year. So the growth rate of the production cost is 6%, so which is different from the growth rate of the revenue. And let's continue. The real discount rate is 8%. So far the information before the real discount rate here is everything is in nominal terms, and here it just tells us what is the real discount rate. So that's why I mentioned earlier that we need to keep that rule in mind. If we want to work with the nominal terms for the cash flows, then the discount rate also needs to be in nominal terms. Otherwise, everything needs to be converted into real terms. So which way to use depends on context. So which way will make it calculation probably easier to do. In this case, I think as rule of the game, as rule of thumb is that probably it makes sense to convert the numbers to have the minimum numbers that need to be converted. So in this case, if we want to work with real numbers for everything, that means we need to convert all these cash flows into real terms. But if we want to work with the nominal terms, then we just need to convert the real discount rate into the nominal discount rate, which will make it slightly easier to do. So that's the path we will choose to figure out this question. And also tells us the tax rate and finally the NPV of the project. Pay attention to the rounding requirement. Do not round intermediate calculations and round your answer to 2 decimal places. So in order to facilitate the calculation, I just put everything here in Excel spreadsheet. So capital expenditure here and the year number here. So I want to fill in these blanks to see what are the revenues for each of this year and cost and depreciation and hence EBIT, right? And then taxes. Taxes are based on EBIT. Remember, as we said in this chapter, for the cash flows, we don't have to consider interest expense, right? Interest expense will be reflected into the discount rate. So that's why taxes will be based on EBIT. And hence, from the EBIT, taxes, and depreciation, we can calculate the operating cash flow. And let me put a blank between the OCF and the other numbers here. Basically, these numbers are provided by the setup. So now let me try to fill in the blank here. Capital expenditure, this is immediately incurred. So go back to the setup. The number is 282,000. So 282,000. And then let's just put the other information down here. Inflation rate is inflation, right? Inflation rate is 5%. 5%. So the growth rate of cost, I believe, is 6%. Right, 6%. 6%. And tax rate, I guess, is 22%. 22%. And the real discount rate is 8%. So as we said, it's probably a little bit more, a little bit easier to convert the discount rate into nominal terms. So then we need to use the Fisher equation, right? Fisher equation. What is Fisher equation? Basically, it's the relationship between the nominal interest rate and the real interest rate, right? That relationship is captured by this equation. 1 plus the nominal discount rate equals 1 plus real discount rate times 1 plus inflation rate. Right, so that this is the so-called Fisher equation. So from the Fisher equation, we can figure out the nominal discount rate. So nominal discount rate equals this whole thing here. I just copy and paste, and minus 1. Just move this one to the other side of the equation, and we can solve out this nominal discount rate. So from that, I can calculate the nominal discount rate. 1 plus the real discount rate, and then times 1 plus the inflation rate, and then minus 1. So this is the nominal discount rate, which we will be using in calculating the MPV later, right? MPV, let me just put a number here. And then let's continue to fill in the blanks of this table. So revenue, it tells us the number for the first year, right? Operating revenues from the facility are expected to be $117,000 in nominal terms at the end of the first year. So this is 117,000 at the first year. And it also tells us the revenues will grow at this inflation rate of 5% per year. So from that information, we can figure out the revenue for each of the subsequent years, right? So that's going to be the first year. The revenue at year 2 is going to be revenue at year 1, right? Times and 1 plus this inflation rate. So this is fine to calculate the revenue for year 2, but what's convenient to use Excel is that we can actually drag the cell to the other years, and Excel will do the calculations automatically for us. But if I just keep the format like this, then Excel will think that this key one, which is this inflation rate here, when it comes to the subsequent years, this K1 will also become K2, K3, and so on and so forth. But that's not what I want it to be, right? So to avoid that issue, I want to fix this cell here. So when I drag the cell down to the other years, this when I add a dollar sign, Excel will know that this cell will not change, but other cells will change. So then now I can drag the cell to the other years, and you can see that Excel automatically calculates the revenues for the rest of the years. So that's the revenue. Now the cost. And also the cost is production cost at the end of the first year will be 42,000. So this is 42,000. And similarly, I think the growth rate of the cost is 6%. So we can use the similar procedure as the revenue to figure out the cost for subsequent years. Again, I want to fix this cell value for the growth rate of the cost, and then I can drag the cell down to the last year, and then the cost will be automatically calculated. And so that's cost. And depreciation, this is easy. So it's because it tells us that the initial cost of the capital expenditure will be depreciated over 7 years down to 0, fully depreciated. So it's going to be B2 divided by 7. But again, I want to fix this B2 here because every year depreciation will be the same. So now I can drag this to the other years, and this is the annual depreciation. So now I can calculate EBIT, right? So that's revenue minus cost and minus depreciation. And then I can drag the cell to the other years, and these numbers will be automatically calculated. And now the taxes will be based on the EBIT, right? EBIT multiplied by the tax rate. So that is my taxes. Again, I want to fix this sale value for the tax rate. So now I can drag the cell down to the last year, and taxes will be automatically calculated. So now I can calculate the operating cash flow. And we know the formula is that operating cash flow we start from EBIT, and then we add back the depreciation, and then we subtract the taxes. Right, so that's the OCF, and then drag the cell to all the other years. And then the initial cost or the initial outlay of this project is simply this capital expenditure. So now I can calculate NPV, especially that since we already calculated the nominal discount rate. So I use this as the discount rate. And then how can I calculate NPV? I can just use the NPV function. But remember that the NPV function in Excel works actually starting from year one's number. It doesn't start from year 0, the initial cash outlay. So that's something that we need to keep in mind. And that's also especially in comparison with the IRR function. IRR function actually starts from the current cash flow, which is the year 0's cash flow, and extends all the way to the last year's cash flows. So that's the NPV function, and the rate here is the nominal discount rate, and then value 1, value 2, value 3 is simply the all the subsequent every year's cash flows. So we start from year 1, and then we input every year's cash flows. So that's NPV. But so far we just calculated the present value of all future cash flows. And then don't forget to subtract the initial cash outlay, right, which is capital expenditure. So this sometimes depending on your format, you might need to change the format of the cells to conform with the rounding requirement. Here I already did that work, so that's why here I don't have to do anything. But if your format does not follow the requirement, then you do need to change the format. So now I can copy the number back, I guess it doesn't allow me to copy, so probably I just need to 42. Is this the, so please enter numbers only. Okay, so 42, 55, 42, 5, 52.54, 40, 40. All right, so I just managed to input the numbers into the blank. I acknowledge sometimes it's just not that user friendly in terms of the inputting the numbers. So now I can check my work. Answer is complete and correct. So I hope this is useful in helping you to solve this kind of problem with the inflation and the cash flows.